Hi, welcome back to Joe Blogs. This video is another in the series looking at the impact of Russia's invasion of Ukraine on the global economy. And in today's video, I want to focus in on interest rates. So we've started to see an increase in interest rates in a variety of countries all around the world. And interest rate increases are linked directly to inflation. Most economies have a target rate of inflation that they're trying to stay within, and the traditional way to fix rising inflation is to increase interest rates, and that usually then brings inflation back down. That's the theory anyway. So in this video, I wanted to talk about what the implications of what's happening in Ukraine are for global inflation, because that is a key metric, and then what's happening in all of these countries who've now decided that now is the time to increase interest rates, and then we'll look at what the likely implications of all of this are for the global economy, because the old theory of increase interest rates, reduce inflation isn't really working. And right now is a really interesting time for governments to start increasing the cost of borrowing across the world, because we've got huge amounts of debt that we built up through the pandemic. And there's a really fine line between bringing down inflation and causing a financial crisis in your own country. So in today's video, we'll talk about interest rates, who sets them, why they set them, and how they go about doing it. We'll talk about the supply of money and quantitative easing, because that's been an important factor in inflation over the last couple of years. We'll talk about inflation itself and the current levels. We'll then look at which countries have introduced interest rate changes recently. I'll talk about Turkey, because Turkey recently introduced a new idea as to how to combat rising inflation. And finally today, I'll wrap up with my summary as to what I think is likely to happen with interest rates, inflation, and the global economy over the next 3 to 6 to 12 months. So before we get into all of that, if I can ask you to give me a thumbs up at some point during this video if you're enjoying the content, and also to subscribe if you haven't done so already. And don't forget that I always include chapters in my videos, so if there's a section you're not particularly interested in, it's really easy to skip over it and move on to the next. An official body in each country around the world is appointed to control interest rates. And the theory is that that organisation should be independent from the government of that country. So you've got somebody who's looking at just the economic implications of what the interest rate should be, rather than the political influence of trying to win votes and keep everybody happy. So examples of these independent bodies that set rates of interest are the Fed in the USA, the Bank of England in the UK, the Bank of Canada in Canada, and the Reserve Bank of Australia in Australia. And these bodies announce the official lending rate. And the official lending rate is then used by all of the commercial banks in that country for setting the rate of loans that they give to companies and individuals. So quite often you will see it referred to as the base rate. So if the base rate was 1%, then these commercial banks would add a margin, their profit, on top of that base rate when they're making a loan to a company. So they might add another 1% to the cost of the loan. So the cost of the loan to the company would be 2%, which is made up of 1% of the base rate or the official lending rate, and then 1% profit margin for the bank. So what that means is that if the official lending rate is changed, so in that example, if the official lending rate went from 1% to 2%, then the cost of the loan to that company would increase from 2% to 3%, because it would be the base cost of 2% plus the 1% margin that the bank is adding. So you can see that the official interest rate has an impact on the cost of borrowing to anybody who has a loan. So in big picture terms, there are three main ingredients that link in to the interest rate in a country. The first is the cost of borrowing. So as I just talked about in that example, the official interest rate in a country will impact on how much it costs for everybody who has a loan in that country to borrow. The second impact is the rate of interest that's paid to savers. So if you have a large amount of cash and you want to deposit it in the bank, you will be paid some interest on that. The bank uses your money, it will lend it to other people. That's how banks work. They take money from people who have too much money and they give it to people who don't have enough, who need a loan. And in order to compensate you for taking your money and doing something with it, they pay you some interest. And the rate of that interest is usually linked to the official interest rate of the country. So to go back to my original example, if the official interest rate is 1%, then the bank will pay you less than 1%. So it might pay you half of 1%. And the banks make profit by lending that money to somebody else and adding some margin on top of it. And the third factor that links to interest rates is the value of currency. Because if a country has attractive rates of interest, then generally speaking, it will attract in overseas investors who are looking to benefit from that higher interest rate. Now, obviously, that's quite a complicated area, and it's not just the case that if you have high rates of interest, then you'll attract in lots of overseas investment. Because if you've got a politically unstable country, or your economy is seen to be out of control in terms of inflation, then you will be less attractive. So a good example of that is Turkey and Argentina, where we've got over 50% inflation right now, and the rates of interest in those countries are currently very high, but they're not attracting in a lot of overseas investment because investors are nervous that the value of the local currency is plummeting, and therefore if they put money into that country, it could actually be at risk. But generally speaking, if you're a politically stable country and your currency is being seen as relatively stable as well, then if you have a high rate of interest, then it will attract in overseas investors. And what happens then is it generally causes your currency to increase in value because everybody wants to buy your currency to put money into your banks, and therefore there's increase in demand for your currency, and that means that the price goes up. The supply of money is an important factor when talking about interest rates and inflation. The central bodies that set interest rates are usually also in charge of the supply of money in each country. And when we talk about the supply of money, we're talking about liquidity. So one of the key ingredients to a healthy economy is to have enough liquidity. So you need all of your banks and financial institutions to have access to cash so that they can either invest that cash or they can lend it to individuals and companies who can then spend that money in the economy and increase the value of the economy overall. So when you hear about the supply of money increasing, what that really relates to is the liquidity factor in the economy. And the way that this has been achieved historically is through what's known as quantitative easing. And quantitative easing is when the central bank of a country starts upon a program of buying government bonds. Now, government bonds are issued centrally to support the growth of a country, to invest in infrastructure, to repay old debt and those sort of things. And those bonds carry a coupon. So a holder of that bond will get paid interest, but their capital is tied up in the bond. It's effectively been given to the government. So in order to increase the supply of money, the central bank will come out and make offers to buy those bonds back from the financial institutions. And by buying it back, what it does is it gives cash to that financial institution, and they will then need to do something else with that cash. So rather than it being tied up in government bonds, it will then go into the private sector, which increases the supply of money to everybody in that economy. And this is what a lot of countries have been doing over the last couple of years. As we entered into the pandemic and we saw lockdowns, we had a real concern with regards to liquidity. We didn't know what was going to happen. So in order to make sure that there was sufficient liquidity and that everybody was still doing business, the central bank started a program of quantitative easing. So we've seen a massive program in the US and the UK, and most of the Western world have been doing this to keep everything moving along. So when you look at the traditional theory, quantitative easing is all about buying bonds. So if you're in the market offering to buy bonds, that generally pushes the price of bonds up. And when the price of a bond goes up, because the interest coupon on that bond is fixed, the net interest on that bond goes down. So to give you an example, if you've got a $100 bond and it has a 5% coupon, then you're being paid $5 every year, which equates to 5% interest. If somebody comes out and makes you an offer of $200 on that bond, you would sell it. And that new holder then has a $100 bond that they've paid $200 for. So they still only receive $5 of interest, and $5 of interest at a $200 purchase price equates to 2.5% interest. So the increase in the price of the bond has actually reduced the interest rate. The coupon is exactly the same, you still receive $5, but the rate of interest proportionately goes down because the price has gone up. So generally speaking, quantitative easing should mean that interest rates go down. And that's what we've seen all across the world. We've had interest rates at record low levels. And the reason for that was that everybody was trying to stimulate the economy. We were trying to get the economy moving again after the pandemic and get everybody out and spending some money. And to do that, you need to make people feel like they've got more cash in their pocket and that they want to spend. The problem with encouraging people to spend is that it can cause inflation. And that's where we are right now. We have got really high levels of inflation all across the world. So all of the central banks have now announced that they're stopping their quantitative easing programs. So the supply of money will start contracting. And the phrase that's now being used is quantitative tightening. So it's the opposite of quantitative easing. We're trying to reduce the amount of liquidity in the economy, to stop people spending and to bring prices back down. If you follow the channel, you'll know that I recently posted a whole video on inflation. If you're interested in watching that, check out the video. So I won't go into a massive amount of detail here. But inflation measures the movement in price of a basket of goods over a period of time. So generally speaking, everybody looks at the year-on-year movement, how much prices have gone up over the last 12 months. And the current rates of inflation that we're seeing all across the world are extremely high. If we look at this chart, it shows the rates of interest for the G20, which are the 20 largest economies in the world. And you can see that currently we've got extremely high rates in Turkey and Argentina, over 50%. But even in the more developed economies, we've got levels that we haven't seen for 10, 20, 30, or even 40 years. So Russia is currently at 9.2%, the USA is at 7.9%, India is at 6.1%, Canada's at 5.7%, the United Kingdom is at 5.5%, Germany's at 5.1%, France is at 3.6%, and Australia is at 3.5%. Now, inflation is a real problem because it reduces the spending power of individuals and companies within that country. And generally speaking, it has a detrimental impact on the value of your country's currency. All countries have a target rate of inflation that they would like to achieve. And at the moment, the general target rate that we're seeing in most developed countries is 2%. So everybody is way above their target rate right now. Apart from Japan, who's at the opposite end of the spectrum, they've got deflation and problems trying to get prices to go up. But everybody else wants to bring prices back down. And the main way of doing that is to adjust interest rates. Over the last few months, the high rates of inflation and concerns about what's happening in the economy have led a lot of countries to start increasing their interest rates. We've recently seen the US increase its interest rate for the first time since 2018, but we've also seen multiple rate increases in the UK and New Zealand, and Canada have also had a recent increase. Now, if we look at this table, it shows the current interest rates in all of the countries in the G20. So we can see that Argentina is off the scale at 40% interest, and Russia is now at 20%, and they recently increased that from 9.5%. So after the invasion of Ukraine, the central bank decided that it needed to double the rate of interest. Now, what's happening in Turkey is very unusual. The current level of inflation in Turkey is over 50%, and the current rate of interest is 14%. But if we look at what's been happening historically in Turkey, up until 2019, Turkey was following the traditional method of increasing interest rates to try to reduce inflation. However, President Erdogan decided that he no longer believed in that theory and that the best thing to do was to start reducing interest rates. So he introduced a very unorthodox policy of trying to combat high inflation by lowering interest rates. And this chart shows what's happened, and you can see that since the new policy was introduced, inflation has started to increase and has increased dramatically over the last 6 months. But to go back to this chart, you can see the recent movements in interest rates in the United Kingdom, Canada, and the USA. But the key point to focus in on here is the absolute rate of interest. So in the UK, the current interest rate is 0.75%. Now that compares to 0.1% that was in existence at the back end of 2021. So we've seen a 700% increase in the interest rate over the last few months. And in Canada and the US, the rate has recently doubled from 0.25% to 0.5%. Now the absolute levels here are still relatively low, but the point here is that we've had a doubling of the rate, and that will have a material impact on some people. Some people have been borrowing to their absolute maximum in terms of buying houses and taking loans, and a lot of companies have got a lot of debt right now. And even a small movement in interest rates could have a massive impact on those people's cash flows and their ability to keep paying that debt. So we are at a point where the economy is very fragile. And if we see a doubling of interest rates, it could be catastrophic for a lot of people. And the issue that we have here is that this isn't the end. This is the start of the interest rate journey. It is likely that we will see interest rates returning to pre-pandemic levels and actually going back to where we were maybe 5 or 6 years ago. So we could see these rates increasing to 2, 3, 4 or 5% over the medium term. And if that happens, we will be looking at multiple increases in the cost of borrowing. And for many people, they just simply won't be able to afford that level of increase. So what's the summary and conclusion today? Well, interest rates are on the rise. That is a fact. We've already started to see it in a lot of countries, and over the next 3 to 6 months, we will see central banks all around the world increasing interest rates. It's the traditional way to combat high inflation. And we've currently got inflation at record levels all across the world. So this is exactly what everybody will be doing. We've seen Turkey try a slightly different approach. They went for the counterintuitive way of reducing interest rates. That hasn't worked. That's backfired. That's been a disaster. So nobody is going to do that. So the only tools available to central banks are to increase interest rates and to reduce the amount of money supply by changing their quantitative easing programs. So we've seen most central banks stopping their quantitative easing. That hasn't really had any major impact. In fact, we've seen inflation rates continue to rise. So now they're going to start trying the interest rate concept. And if you follow this channel, you'll know that we've been talking a lot about commodity prices and what's been happening in the wider environment. And one of the problems that we've got right now is that global prices are being driven up by what's happening with raw materials and commodities. So even before the Russian crisis, we had high levels for oil and natural gas and minerals and food products. But since the invasion of Ukraine has started, we have seen all of those prices take off. They are up 2 or 3 times versus where they were on the long-term average. So we've got a real problem, and that's fueling inflation all across the globe. So increasing interest rates won't solve that problem. Causing people to have less money at the end of the month and to increase the cost of their mortgage and any loans that they have, and for companies to have to pay more to the bank for interest each month, isn't going to help solve the inflation problem. What it is going to do is put a lot of those people into financial difficulty. So we'll have a lot of individuals and companies struggling to actually make those payments each month. And that's the big risk here, that the central banks get too focused on trying to solve inflation, trying to bring the inflation rate down to the target level. And they forget about what the knock-on implications of that are. We have got record amounts of debt all across the world right now. Governments have borrowed heavily to keep things moving through the pandemic. Individuals have borrowed heavily, and companies have taken on a lot more debt to try to survive through that period when we were in lockdown, where we were having furlough schemes and other support schemes. So everybody is really creaking at the seams in terms of the amount of debt that they're sitting with. And the only thing that's really kept everybody's head above water is the fact that interest rates have been so low. So it's been pretty cheap to be able to keep those payments going. If we're now seeing interest rates starting to increase by 50% or 100% from the low levels that we've currently got, that's going to cause a big problem for people, because the banks will pass on that increasing cost immediately. So everybody will feel the pain straight away. It's not going to change inflation overnight. It's not going to have any impact on inflation, because inflation's being fueled by things that are happening elsewhere around the world. But what it will do is cause local economies in each country to start to struggle. So we may well see spending come down, but that will be at the expense of company profits. We may see companies starting to get into difficulty, to go bust. People may start losing their jobs, and therefore they'll spend less. And if you lost your job and you've got a lot of debt, you're in big trouble. You could lose your house and your home. So there's a lot of really important implications for increasing interest rates. And I think it's quite likely that the increase in interest rates that we will see over the next 3 to 6 months, that the Fed will bring in, and the Bank of England, the Bank of Canada, they'll all bring in these higher rates. It's going to cause problems. It's going to potentially cause a slowdown in spending, and it even could cause a global recession. I think there's a real chance that if the central banks go crazy and start hiking rates, and we get rates of 1 or 2% coming through over the next 12 months, then that will trigger a major cash flow problem for a lot of people and could easily cause a global financial recession. So hopefully you've enjoyed the content of this video, the structure, the detail that I'm providing you with. If you've liked what I've said today, then please give me a thumbs up and don't forget to subscribe if you haven't done so already.